Welcome everyone to the third episode of our East Capital Group Global Outlook series, this time on China. My name is Karin Hearn. I'm the Chief Sustainability Officer of East Capital Group, calling in from Hong Kong. And today I have the pleasure to have with me two of my colleagues, also working out of the Hong Kong office, who are currently in the mainland. It's Dmitry Vlasov, Portfolio Advisor, and Hao Zhang, Assistant Portfolio Advisor. So yes, today we're going to talk on China. And by the way, if anybody has any questions, you will be very welcome to ask them using the Q&A function that we have here in this meeting. So yes, China had pretty poor performance last year in terms of equity market performance. And this year it's also fairly disappointing. Just to give some numbers, we have the A shares, i.e. the onshore Chinese equities, minus 8% since the beginning of the year. China onshore is also down 6%, which looks really weak compared to developed markets which are up 15%, and emerging markets which are up 4%. So let's dive in, and I will go straight to you, Dmitry, to tell us why you think this performance has been so weak so far.
Well, there have been a list of issues that impacted the sentiment and the performance in China markets, both onshore and offshores. And I think these issues, they're well known: geopolitical tensions, unsteady pace of economic recovery in China, with high expectations at the beginning of the year and the expectations coming down. But I think one of the major issues that has been impacting, sentiment and performance is actually the state of affairs within the property market in China. So on this slide, we put some, some numbers there, and you can see the key indicators, related to the property sector. So you see that, it's been a very bad, beginning of the year, and that's continued with 2022. At that time, we had the new starts down 40%. This year is 25%. We had some good sales at the beginning of the year, with positive year-over-year performances, but now it's again negative 5.5% year to date. So again, difficult conditions. And then obviously that goes into the fixed asset investments, the real estate investments. Year to date actually down 8.8%, and that's after the very difficult year last year, which was down 10% year over year.
Okay, so property sector, which I know you've been following for a very, very long time. I remember the number of times we've been visiting some real estate projects all over China, Dmitry. It's very important. Also, as you said, macro, also very quite weak in terms of consumption. We also hear from investors and probably as well, I would say, from people on the ground. There is a third element, which is related to geopolitics. On this, I would actually like to ask how to join, especially how, because you're just back from Taipei, where you've been for 2 days, I think, 2 or 3 days of meeting with companies and other investors. So what's your take on this specific geopolitical tensions?
Hi, Karin. Thank you for the question. So I was in Taipei, as you mentioned, for 2 days, meeting quite a few Taiwanese companies, especially focusing the tech and then AI area. I would say most of the companies, and including some investors as well, they pretty much have a more pragmatic view on what's going to happen over here. And then because of the conflicts or tension across the strait has always been there. But what the business people are thinking about is that they will have their own plans to really planning for the current reality. So what they do is they have plants everywhere in Taiwan, in China, in Southeast Asia, in Europe, in America, so that they can always supply to their clients in different areas and to avoid conflicts of interest depending on different regulatory rules, etc. So in that sense, they are quite well prepared. And then, of course, depending on the outcome of the election, which I don't think would matter that much, unless there were really some outlying event happening, I don't think there's be much changed. Like many things I don't think many things will change from what we are seeing right now. So in that sense, I don't think we need to worry so much.
Okay, so probably, as always, there's a real topic in terms of perception, and seeing it from afar, it does look pretty bad when you have this combination of, as we're saying, of weakening macro and some concerns on the ground, and of course geopolitical tensions. But on these actual specific concerns, what I would like us to discuss a bit more is what are your impressions? What are your feelings regarding the primary concerns related to the Chinese economy and to the Chinese consumption sentiment?
Yeah, what on this slide, we actually put some more data there, and you can see that indeed the economic recovery, at least this year, it hasn't been it hasn't been even, so it's been a little bit unstable, and I think that's one of the key reasons for the weakness in the equity markets. But obviously, China, fixed asset investment has been growing, quite healthy levels, but because of real estate this year, it's only 3.2% growth year over year. Retail sales, and I think when we started this year, the expectations for the retail sales, they actually were quite high, but now people taking down these expectations because the recovery in the retail sales that, last year we had very easy comparisons. It was negative year over year, impacted by the zero COVID policy, but it started okay, but then in July we only had 2.5% retail sales growth, and that's really low for China because this is nominal, and inflation in China is very, very low. Actually, it was deflation in the month of July. The good thing, we saw some improvements in August, so it went up to 4.6%, but still it's behind the expectations that investors had at the beginning of the year, and obviously it's one of the reasons why some economists and strategists, they're taking down the GDP growth this year in China to below 5% levels. So I think those are the key factors contributing to this. I think that also you see year over year some negative comparison within the export part of the China economy, but that's expected. That's more like external environment, and don't forget it comes after a very, very strong 2 years when Chinese export was growing double digits, I think it's probably expected.
Okay, let's move on a bit, and instead of talking about numbers, which are of course important, maybe let's please share with us your impressions on the ground. For instance, what I mean, when you go around in mainland China, what do you notice anything? That would be very interesting to hear.
Yeah, sure. So from my end, from what I see every day, I do think that the service sector, especially consumption, is not weak at all. So for example, like the restaurants I go to, I see quite long queues there. I need to wait for like 15-30 minutes. Usually I don't wait, but for now I need to wait a bit for the seats. In the parking lot, I need to spend some time finding a spot to park my car. So from that sense, I do feel that consumption is not weak. And a lot of people worried about youth unemployment actually. I don't see that's much of a concern either. And then the reason I think is really because right now in China, the society and then the type of employment of business developed into an area, for example, like on the street, you see a lot of like TikTokers, or there's no YouTubers, but something like that. Basically, they do they do live streaming, they discuss a lot of things with their phones and then just showing that's being at the key opinion leaders. So that's kind of like employment. I don't think is really like calculated into the formal employment. So in that sense, I don't think user employment is. I do agree that there might be some employment, but I don't think it's that big as compared to what a lot of people have been fearing about.
Okay, interesting. Dimitri, do you also have some comments to make on your observations? I mean, you've been traveling and investing in China for soon 12 or 13 years. So what would you say?
No, it really depends what part of the economy you're looking at. Obviously, property has been kind of a pain part so far. But the consumers, especially if you look at catering sector, restaurants, it's actually doing quite well. We are getting double-digit numbers in terms of year-over-year growth, and obviously people want to travel. Right now, the constraints there within the system because we still have inadequate travel capacity, especially for the outbound flights. So obviously what's related to the property, to the fixed asset investments, it's been more difficult. On the tech side, I think it's also it depends which part of the tech part you're looking. You probably many people heard about a recent release of the new products by Huawei. So those are quite good phones, and they managed to develop in-house capability for the 5G connectivity. So which is quite interesting. So there's some parts of the markets that are doing relatively okay and trying to adopt to the new environment, and then some of the markets are suffering. But the confidence, of course, the confidence level is probably, I would call it suboptimal. So I think the government realizes this. Starting from the end of July, we are really seeing intensification of the supportive policies, and the most significant they were enacted just a few weeks ago related to the property sector when they relaxed a number of restrictions in tier 2 and tier 1 cities. The interest rates that people get in for purchase of properties, they're actually quite reasonable now. We just need the confidence to get back, and the government, I think, realizes this and started acting, which is good.
Positive sign. So maybe we can speak a little bit how we are positioned for this and on this environment. I think there is a slide to show how for instance, our East Capital China A share, so a fund which is focusing on on onshore domestically listed equities, is doing. Has this changed in a significant way, Dimitri, or it is more or less what it's been for a while? And can you please tell us your thinking here?
Yeah, I think the thinking here is that there's a lot of interesting valuation opportunities within the Asia market, and what we are where we are getting some where we are finding some interesting values. It's within the sectors that are leveraged to the recovery to the economy. So we are actually running quite big overweight in the materials, which is probably few people in China in the investment world are doing, and it has been one of the biggest contributors to our alpha this year, actually. Consumer, we still believe in the strength of the consumer in the recovery, so it's just being delayed, but in general, we think that it's coming. Where we're a little bit more concerned, because there is because of this interest and excitement over AI earlier this year, there's a lot of stocks within the IT space. They actually don't represent attractive risk rewards profiles for us. So we are running quite big underweight within this sector. Also, industrial part, I think it's been a bit more difficult and maybe impacted by weaker export or manufacturing activities. So we also underweight. But in general, it's tilted towards economically sensitive, maybe higher quality, bigger names. That's where we are finding the opportunities right now.
So in terms of names, I think, was it you or how there was, we wanted to speak about a couple of our stock picks. We have, who wants to start? Shall we go with VIP Shop maybe? It's a name that that not everybody is aware of.
Yeah, sure. So Vipshop is actually one name that we added last year, which performed extremely well. Basically, the company is a e-commerce company that specialized in discounted off-season products, such as but more focused on apparel, footwear, cosmetics, etc. So basically, in terms of the industry trend, we're seeing a bit of consumption downshifting, especially in those areas. So this company focused on that, which have a relatively better competitive landscape versus the general normal e-commerce companies like JD.com, etc. And then in terms of how business improved, this company actually we have been seeing margin improvement from earlier days of 4% EBITDA margin to around 8.5% this year. So their business did improved during the difficult times of COVID. And lastly, the valuation and then the share repurchase from the company give us more of a margin, a safety margin. As we can see, it is a 7x PE company with a free cash flow yield of 12-13% for this year and next year. And what more is that the company has been doing actively share repurchasement, and then they're doing one more this year after the one they just finished. So we think that's a very good business and a stock with a share I would say stockholder friendly repurchase plan from the management.
Indeed. Great. Dimitri, there was one company you were specifically wanted to talk about. We are running a little bit short of time, so but maybe you want to mention it because it is an interesting case as well, but we have in our A-share fund.
Yeah, indeed. Hao mentioned the case of Vipshop, which is great, but this is the company which is listed offshore, and right now the valuations within the offshore markets, they're a bit, more attractive, so to speak. Within the A-shares, we have a company called Midea. It's one of the largest household appliance manufacturers. So the company, is the lead in many segments of the China household appliances. They are dominating the aircon, the refrigerator, washers. So, and this is a simple business, but the company is doing so well. So they're, it's not necessarily the easiest environment, but they're actually growing their sales double-digit this year. So they are benefiting from the recovery, at least in the completion of the properties. That that's the only positive part year to date within the property market. So they have a big export business, more than 40% of their sales, again, benefiting here from weaker RMB that we have had this year. And then it's similar to the previous case, to the Vipshop. They are generating quite high levels of free cash flow, increasing the dividends. So well managed company, growing at double digits numbers, and not expensive, the kind of 10-11 times earnings.
Okay, that sounds very interesting. So it does sound that more challenging market environment, maybe there is still a lot of interesting stocks and a lot of interesting investment cases that we find. Also spending time traveling and meeting these companies and having the boots on the ground for the market to recover in a significant way. As we mentioned here, like how you were talking about geopolitics, clearly it will be good with a little bit more positive sentiment, which we started to see. We also probably are entering a period of time where there will be more fine-tuning in terms of monetary policies and fiscal policies. So that's all very interesting. But I think before we close this session, we would like maybe to show us a last slide which is about the valuation of the indices today, and especially considering the fact that we actually have a number of, if you look at the positioning of global investments, of global investment funds, they have a strong underweight on China. So Dimitri, could you please share with us some of your views on the valuations?
No, I think valuations, they are attractive. If you look at the onshore, it's trading below average, even though we are having recovery this year in terms of economic performance and earnings growth. And also, the valuations are especially, low for the offshore listed Chinese equities. That's on the right-hand side, the chart. So what I can say here, I think it's extreme pessimism, embedded here, and I think it's, maybe it's not right here, because we are seeing that stars are lining up for performance to improve, with the government being more active, with corporates adjusting to the new realities, and hopefully consumer confidence improving. So then you have this level of valuation. So I think quite interesting for the future performance.
All right. Look, I would like to say that probably, as always, China is going to be a very important market to monitor. I would like to thank you, Dimitri and Hao, for joining us tonight today for us here in Asia for this webinar. And I would like to tell the audience to first thank you for your attention, but also telling you to stay tuned, because we will talk more about China, obviously, as the most important emerging market in the world, in the next and final episode in the East Capital Group Global Outlook series. So this one will focus on global emerging market, and is coming up next week on September the 28th. Until then, thank you so much and have a good day.